Family trusts can save you thousands of dollars in tax, and it's why most rich people use these structures. So I wanted to talk through what they're all about, how they work, and what you should be thinking about if you want to leverage the tax saving power of a family trust. Now, a trust works like an individual. It gets its own tax file number. So basically you register it through your accountant or lawyer, and you'll go get a TFN. At that point, you can open a bank account, you can open an investment account, and you can even buy property under the trust. Now, the key rule of family trusts or discretionary trusts is that all income from a trust needs to be distributed each year to another tax-paying entity. If it's not distributed, then it's taxed inside the trust at a rate of 47%, which basically makes the trust pointless. So you basically want to pay out all income to another person or another tax-paying entity. And that's quite important because a beneficiary of a trust, it can be individuals, or it can also be other related entities like a company. Now, a company's tax rate is a flat rate of 30%. And so that means that if you've got income generated inside a trust that you don't need for spending, which if you're trying to build your investments and wealth for the future, then you probably don't need the money right now, you simply direct the funds into this company, and then you cap your tax at a maximum rate of 30%, which is way lower than personal marginal tax rates, which are up to 47%. Now, the good thing about trusts is that they're flexible in that you can change who you distribute funds to each year. This is particularly powerful for families when they're thinking about starting kids and starting families, when you might have someone working on a part-time capacity or a reduced capacity, and that may change from year to year because on some years when it's beneficial, you can distribute to mum. On other years, you could distribute to dad. And if it's not beneficial to distribute to either of them, you know that you can use your company and not pay more than 30% tax. A lot of flexibility, a lot of control, and you can shut down a trust if you're not getting benefit out of it and simply take the assets out into your personal name as well. That tax saving power, along with the flexibility, is the main reason that this is one of the favorite entities for people with a lot of money.